and how the market is on the
October, we understand that October,
when you talk about partial,
it was
looking at the single market at 1 day. That's why we say look at the price of one product. The others we don't.
That should be
we
6.
assume they're fixed.
That should be 26. Then I had
analysis of all
that should give me 27
units. That should all the market 7.
We say that should give me
that should give me.
So that I proceed to types of equilibrium. Fifth should give me 27 days.
We go to the
types. When I proceed to November, November ends with how many days?
Types of what we call equilibrium.
November ends with how many days?
Talk about types of equilibrium.
November ends with how many days?
Types of equilibrium.
That should be 30
we
days.
have what we call stable.
We have what we call stable.
Then finally,
unstable or disequilibrium.
Then we have what we call mean.
So I want you to add for me the number of days. Add for me the number of days.
Equilibrium.
I want you to add for me those number of days.
Stable equilibrium. We have.
I want you to add for me those number of days.
This equilibrium.
So I want to add for me 27 to
we have what we call
1
stable.
5,
what we call unstable.
1, 31, 30, 27, 30, 15. What is the total number of days?
For the neutral
that you have.
Equilibrium.
What is the total
we have
number
of neutral
that we have for that?
Took us about. And I hope you're enjoying our class. Are we together?
Total number
and we have what's called the neutral equilibrium.
So if you have that,
what wants to start with
what you have
stable equilibrium. And how do we
total number of days? That is 3.
We have what's called stable.
Does this person qualify to be a resident? Based on the criteria that you have,
equilibrium.
Does Mary qualify to be a resident?
Equilibrium.
So allow me to draw the diagram. Then we discuss this. We draw the diagram, then we discuss this diagram. Does Mary qualify?
Basically discuss this diagram.
Mary qualify to be a resident, and that will be. It was there. It does not have a permanent there.
So we have
there.
This was there. Equilibrium quantity. This is price
for the period.
Equilibrium price
period.
For the period points here
of
and then
183.
This is P2.
Or
this
more.
is what's called P1.
P1. We call it.
I hope you're able to see the board. Are you able to see the board?
Call it during the year.
Are you able to see the board?
Of what I call.
I hope you're able to see the board.
So during the year of income,
if you're able to see the board,
consideration. Mary was there for a period of 183 days or
our
more
attention
during the
brought
year
to
income and number consideration. That was criteria 3. Together, team. Then I want us to pick on the last criteria. So if you look at that point, an individual example 3.
If you look
at our last point, just to depict those scenarios, example 3, we call this gentleman Peter. We call the gentleman Peter, and into bracket, no permanent home. Into bracket, this gentleman does not have a permanent home. Call him Peter, and you basically say that this gentleman
well and good
does not basically have
what you call
a permanent home.
So this is
QS1. Peter,
call it
QS1. Does not have
QD1.
What you call a permanent
call
home.
it QD1.
But I want to think it was there for the year 2024.
What you call Q
is there for the year 2025, 23.
QS
and it was there for the year 2020.
QS2. This is QD2.
So Peter is there for the year 2021. If I look at year 2024,
QD1, QS2.
I say Peter is there for the 200 days.
QS1.
So for that, Peter is there for 100 days.
Are we seeing that?
If I look at the year 2023, Peter is there to the equilibrium point. And I have days.
Arrows moving to the equilibrium
Peter
point.
is there for 300 days.
Yes, come on.
Then finally we have what
so I guess we can basically understand
year
what's called
2022.
excess.
We
call
have
it
Peter being there
excess
for 100
excess supplies.
Peter being there
that is what for
supplies.
So
So look at that very
down
quickly.
here we have
If you look at
what is
criteria
called
1,
excess.
does it qualify under criteria 1?
Demand.
No. Are we together?
We call it excess
Using
demand.
criteria 1, Peter
This
does not
should
qualify
basically be a shortage
because
with
Peter
excess
does not have a
demand.
permanent home.
It creates what's called a shock.
To
A
get
shortage.
Peter
Tafadhali
does
kila
not
mtu
have a permanent
abonyeze
home.
yes kama ako
So
na
therefore,
mwalimu.
criteria 1 does not fall under
Kama
that
uko na
category.
mimi,
Tafadhali. Together.
tembea na
Criteria 1 does not fall under that category. You give me a yes as we proceed. Provide a yes.
tembea nami kama uko
So
na mimi.
criteria 1 does not basically fall into that group. So I look at criteria 2. So we're basically being told that if a person does not have a permanent home, criteria 2 basically focus on the year
So
of
we
income
can
under
discuss.
consideration. If I depict that year of income under consideration,
If you look at that
it should
diagram,
be 183 or more.
at price P1,
look at these prices based on criteria 2.
these
Does it
prices
qualify?
are called
they should be
based
moving back
on
to
criteria 2.
They're called P1 and P2.
And so therefore,
in economics,
if it does not qualify for criteria 2,
price,
I look at
those
criteria
two
3,
prices, P1
where
and
I'm
P2,
saying a person
we
may
call
not
them
have a permanent
disequilibrium
income. But if you look at the days
together
in the year of income under consideration, plus the 2 preceding
we
years,
call them
then you find the average.
If it's
and the
more
one that
than
we
one
had
call
then
the
it
disequilibrium price
look at the
is whenever we have this
so the
price
year of
P1,
under
this will
consideration
cause what called
have
excess supply. 100. So we have plus 300. Then you have plus 100. Equilibrium shift from PE and QE and move. What is the average? Whenever you have P1, it also causes a disequilibrium for the average. And at this point, basically, it causes what you call excess demand. What is when the price is low? The average. So that is to say, so the average is P1. We round it up, that's one low price P1. So does it qualify to be a resident? Low price. Does it qualify to be a resident? We call it P1 at low price P1. Does it qualify to be? Yes. Why? Because not clear. Is the same person. Basically, is everybody experiencing the same thing? Is more than 122. Tafadhali. Yes. So the average is more than 122 days. Somebody says the average is basically more than 122 days. I hope everybody will respond. I've only got an assignment for one person. If you don't respond, you are only Malimo. So please submit your assignment. Very important. I know why. Yes, the board is not clear. I'm very big on assignment. I don't think so. The units that people pass, particularly you find assignment. Is the handwriting small or the board? So when you talk about residency, in relation to limited, kindly let me have residency. Residency. Are you experiencing something? In relation to, if you don't talk, what you hold limited. To a limited company. It's not the handwriting, it's a body corporate. Body corporate. So let me use my gadgets for residency in relation to a company. How would they define, for example, that this is in relation to taxation? How would they define that this company is resident? This one is non-resident. How would they define that this company is resident? This other one is basically non-resident. How would I define that this particular company is resident and that other particular company is not resident? This one company is resident and the other company is definitely non-resident. How would I basically define that this company is resident, the other company is non-resident? So basically understand that the following criteria we just discussed before you jot them down, the following is considered with that. So a company must basically meet the following criteria in order to be considered to be a resident. So basically the 3 criteria in order for us to classify a company as a criteria or not a criteria. But we start with the criteria for us to classify a company as a resident company. Let me check. Number 1, we say if a company is registered in Kenya using Kenyan laws, then that company qualifies to be a resident company. Resident company. Just make sure that today is when it wants to discuss. A company is basically registered. Why is it today you got? Using Kenyan laws. That is a let me check company. Let me just tuko pamoja. Criteria number 2, the management and control. I do not want to waste any time. Say that the management and controlled. Let me see what happens. Exercised in Kenya. Is it getting better or is still under consideration? Not good. Criteria 2. Is this getting management, structural control was exercised in Kenya getting better during the year of income under consideration? That basically implies that the board meetings were basically held in Kenya during the year of income under consideration. It basically implies that the board meetings were essentially held in Kenya during the year of income under consideration. That is criteria 2. Is that criteria 2 at all? You give me a yes if that criteria 2 is at all.
Recording in progress. Recording in progress.
Then the last criteria, in order for us to basically qualify a company, we say that it has been gazetted through a Kenyan gazette by the Cabinet Secretary of Finance to be a resident company. It has been gazetted by the Cabinet Secretary of Finance to be a resident company, and that company can qualify to be a resident company. So if you're looking at residency in terms of company, we look at those 3 criteria. Tuko pamoja. Team, we look at those 3 criteria.
Is it getting better? Because I'm seeing we have the notes. Should be getting better. Do you have the notes? Yes, we have the notes. We don't write. Should be getting better. Is it? You only write what is important. Evans, do you have the notes? Communicate. You only write what is important. What is important? Priska, my representative. Therefore, you should be. I will basically say that if telling me what is happening does not basically totally above criteria or below, depending on where they appear in your handout. If the company does not meet the criteria that I've just is it totally bad, Kitawe? Therefore, that company will be a non-resident company. Kitawe, together. If a company does not meet that criteria that I've basically talked about, then we say that that company is a non-resident. On my side, I seem to see together. I seem to see a change. If the company does not meet the criteria that I've talked about from the we consider that company as a non-resident company. Together. Okay, now we respond with a yes. Just a yes. Then you put okay. Is it okay? So then we proceed and we talk about the limited company about consider this resident low price P1 company about on meeting. So what is happening? The meeting demand call it on meeting. Quantity supplied is low, but quantity demand is high. On meeting the following quantity supplied, we call it criteria. Supplied on meeting is the following low criteria. On basically meeting QS1 the following criteria. So at the one supply is low QS1 operate in Kenya, while quantity demanded or while quantity we have somebody called incorporated demanded in Kenya, we say is high, and we say using say it's high. What we call Kenyan QD1. So quantity supply is low at QS1, while quantity management is high at QD1. So what we call control. Are we able to see that? Control QD1 was quantity supplied is less at QS1 exercised in but Kenya. Demanded is high at QD1. Kenya. Are we in agreement during? Are we during the agreement? If we income agreement to bonyeze yes to say under consideration. It is a time that every minute counts. Consideration. Are we together? So that basically when that happens, this creates what we call excess demand. When it's low, we say this creates what we call excess. That basically implies that board meetings. So when that happens, that creates what we call excess demand. During that's why we have excess demand there. Into brackets we have held. Into brackets we have what we call short. The board meetings were into brackets we have held what we call shortage, and in what we call meetings were held in Kenya. In the market, have the board into brackets we have shortage in the market. Gazetted the excess demand. Gazetted the excess. Gazetted excess demand. Gazetted by say push what we call the cabinet secretary. The excess demand in some pushes. The excess demand in some pushes. We say of finance price from P1 of finance pushes price to be price say to be a resident to be a resident P1 company say to P to be a resident company. So as I say, if the company does not demand the above three criteria, good student, that company pushes this price P1 to P non-resident. I think that company it pushes the price from P1. So I want to talk about significance of being a resident people. It pushes the price from P1 to P, difference. So we say as price increases, difference, we start with individual. As the price, we start with individuals. As the price increases, when price, so if we have a residence, we know that on this price is increasing, and non-quantity supplied, what we call increases, resident. Quantity, we have supplied, called non-resident. Supplied, a resident. We say, and then we basically have what's called a non-resident. We say from what is the difference between being a resident from and Q being a non-resident. So this quantity is increasing. Just to look at the quantity supplied is increasing. Number one, and they say from QS1. If you're a resident person and it's increasing, your income is basically taxed from whatever earn. It's increasing. If you're a resident of S1, your income will be taxed from whatever earn. While let's say, for example, for the athletes who are residents of Kenya. If they go to New York, they go to Europe, they go to Asia, and there are those places that tax in both countries. In both
quantity demanded is increasing, quantity supplied
the tax in both
but
countries.
both of them towards equilibrium price. Both towards equilibrium price. Both.
The tax in both countries.
And
I'm saying that the nitty-gritty about it.
Equilibrium.
The nitty-gritty about it. The details about it. Emmanuel Kabi, Anna Blessy, I will talk about them in advanced taxation. There's what we call double taxation relief, where two countries can agree. Let me just equilibrium price. Two countries that are subjected to double taxation
both
can agree to work on two things. There's what
equilibrium price, and that we know that
where this country will say once you've taxed the country,
we look at the second scenario,
and that is say on exemption.
The other hand,
but then we have the second clause that we call
on
the
other
credit
hand
method.
Now,
where
your
price country
high, you'll be given
a
high
price of the law of the two taxes.
High,
they compare the tax that you pay in the other country and the tax that you're supposed to pay in Kenya. Then you're granted the lower of the two together. But I've said that if you're a resident person, you're going to be taxed on income in Kenya and outside Kenya. But for a non-resident, quantity supplied is going to be income that they have quantity supplied. The only tax supplied is going to be income that they earn is in Kenya. The second difference, I'm entitled to supply relief. A resident is entitled to what they call a personal relief. Non-resident is not entitled to what we call a personal relief. A personal relief.
So quantity supply is
QS. Non-resident is not entitled to what we call a personal
while the quantity demanded, we know is low. We know that demand when the price is high, quantity demanded is low.
Then the third difference, when you talk about withholding taxes, withholding tax is a small topic on its own. So when I talk about withholding taxes,
so what is happening
basically
when
taxes
that
that are
so this creates excess supply.
For those who are doing consultancy, for those that are doing consultancy in this class, are we together? For those that are doing consultancy,
what we call excess,
we understand that if you're a resident person,
excess supply,
and you're doing consultancy,
this
you will be entitled to what we call
supply
withholding tax.
This
and withholding tax in a simple language, these are taxes that are deducted from the excess supply source together.
Into brackets.
So if you're a resident and you're entitled to a withholding tax, the withholding tax
into brackets call it
are we together?
Surplus.
If you're doing
in the market,
a consultancy,
that is what called surplus.
If you're doing management,
it creates
and you
surplus in the market.
have a withholding tax. So if you increase withholding tax, is not always fine.
What is supplied is
at the end of the year, you're still going to be subjected to further taxation. You're still going to be subjected, if you're earning a professional fee, you're still going to be subjected to further taxation
in the
and
market.
they'll remember that you've already been
Producers are happy,
but
consumers are
But when I relate that concept to a non-resident
market,
we basically understand that for a non-resident,
but the consumers,
when it comes to withholding tax, it is usually final.
They're not usually
at higher rate.
Are we together?
Withholding tax,
we need to
is usually what you call a final term. Is usually what you call a final term.
Excess
Tax. Are we together?
supply.
They're not subjected to further taxing.
We'll say
Once
that
the
excess
withholding
supply
tax has been deducted, they're not subjected to further taxation.
We need to understand
Together.
the excess supply.
So that is the difference in relation to a resident person and
down
the
the
price
price
person.
Pushes
The
down
difference between
what it calls the
resident
price.
and a non-resident person. Is that understood?
Pushes down the price
We
from
respond in the yes if that is
pushes down the
understood.
price.
Perfect. So we can
down.
put it down.
Excess supply
Resident
pushes
is
down the price.
P2
is taxed. We know that from P
taxed
to P
taxed.
So it's
On
reducing this
income.
arrow.
Are you able to see this?
And it pushes the price
In
from
Kenya
P2 to PE towards
in
equilibrium
Kenya,
price. You can say outside.
So as the price
And
decreases,
outside
as the
Kenya.
price decreases,
This person is
when that
taxed
is
on
happening
income
as the
and in
price
Kenya
and also in Kenya.
taxed on your income and in Kenya.
Tax.
The time decreases only as the price
Was
is decreasing, as the
And
price
income.
decreases, as the quantity supply decreases, only as the price
income and
increases
Kenya.
quantity, then
The
supply,
second,
there was one. The second, entitled, when time decreases,
entitled to what they call personal.
so quantity supply
Personal
decreases
relief.
from personal relief, from what they call QS2. So
So
now
when
when
it's not
decreasing
entitled
quantity
to
supply
personal
will
relief.
now be decreased, not decreasing. Are we together? Entitled, while quantity demanded,
not entitled to what they call
While
personal. But
quantity demanded,
So not entitled to what's called personal
while
relief.
quantity demanded
You say when the sun will increase.
Will increase
from will increase from QD2.
Withholding tax
Will increase from
what we call the
QD2.
withholding tax.
All of them are increasing.
Withholding tax on
This one is
income.
increasing. This one is
On
decreasing
income.
towards equilibrium. So both towards equilibrium
mean
both
not the final.
both towards.
So in this case, withholding tax on income.
Equilibrium. Prime equilibrium quantity
Holding
tax
on income.
both of them towards equilibrium quantity.
We say it is usually
Both of them towards equilibrium quantity.
usually
QE.
final.
Both of them towards equilibrium
Withholding
quantity.
tax on income
QE.
is usually
To the
final tax.
Both of them
Both of
towards what we call equilibrium
We
quantity.
respond with
QE.
yes.
Tafadhali tubonyeze yes.
I want to summarize that information.
Now
I want to summarize that
relation to-
information.
Call it in relation.
I want to summarize that
limited
information.
Now limited
I want to
company.
summarize that
Resident and
information.
non-resident. Here's the difference, We
Uh,
have resident.
Thank you. So as a
Resident
summarize,
and non-resident.
as a summarize, I've told you that
This price P1 and P2.
the difference in relation to taxation that is for
This
resident company and a non-resident company. So we understand that for resident,
These ones are what this
Corporate
causes what called disturbance.
say at corporate
That
rate,
is what called disturbance in the market.
at
The price
corporate
P
rate,
to na P1
of
are
30%.
what you call disequilibrium
so
price.
tax at corporate
Price
rate
together.
of 30%.
They cause
For the
disturbance.
non-resident,
Disturbance altogether.
tax
So a market is
at
stable. I'm just
what you call
explaining.
a corporate rate.
A market is basically
Corporate
stable.
rate.
You realize when you have
What
what
you call of
P1
37.
and P2, the market will still go back to equilibrium.
So if you're resident,
The market will still go back to
corporate tax,
equilibrium price.
corporate rate of 30%
That
of
is
the
a
tax
stable
on
market.
income.
And despite the
Together.
disequilibrium
For
of
non-resident, we tax them
in the market
at
that is
7.5%.
P1 and P2, the market
Percent.
still will get back
Tubonyeze
to
yes
equilibrium.
kama tuko pamoja. To the
But you
equilibrium.
can say it with
And that is what you
exception,
call the
which
DC
equilibrium.
exception.
That is what you call the stable equilibrium.
Exception of
Stable equilibrium.
when was the tax
So we're
law?
saying that
With the
despite
exception of
this
2020,
equilibrium prices, the market
when there
will
was
still go
COVID,
back.
the rate was
So excess supply will be
COVID
close
2020,
to
the rate was
excess demand will
with
be
the
close
exception
to
of 2020 when you had COVID.
back to equilibrium.
How are we
That is
taxing
what you call
the
the
rental
stable.
company?
We
We
call
were
it
taxing them
stable
at corporate rate
or
of 25%.
equilibrium.
So that is
Definitely
not
you
for
call
that.
it stable. I hope we
Summer
are
stop.
together.
So
Call
let's
it
start
stable
on taxation of
So
employment.
despite the disturbance, the market will
Taxation
still go
of what we
back
call
to
employment.
the market will still
Move
go
to
back
employment
to the equilibrium prices.
So we move to
Tafadhali tubonyeze
taxation.
yes kama tuko pamoja.
Call
Tubonyeze
it
yes kama
taxation.
tuko pamoja.
Taxation
Tubonyeze
of what
yes
we
kama
call
tuko
of
pamoja.
employment, of what we call of employment income. Taxation of what we call employment.
So then I discuss the next market taxation
of what we
So
call
stable
employment
market.
taxation
Call it the market
of employment income.
This
Most of our
equilibrium
work in this class. Is it true?
Are we together?
What we
Most
call
of us
unstable
work in this class.
unstable
Do you pay? Yes, you
equilibrium.
do. Yes. And most of you pay you together. So
Market
number one is to define
equilibrium.
what employment
So what we
is.
call
Are
unstable
we together? This equilibrium.
So
Whenever we talk about
if you talk
employment,
about
stable equilibrium,
this is basically a
this
relationship
occurs when
between
the divergence from
employers
equilibrium
and
position.
employees. This is
occurs-
basically relationship
Occurs, we
call
call
it
it.
a relationship.
We say when the
We
divergence
have it between
divergence
a person that we call employer,
call it from
employer,
equilibrium
and what we
positions.
call the employees.
Are
when
we
the
divergence
employer
from equilibrium
and the
positions?
Just to dissect,
When
we
we
don't
not
call
the
question that
divergence
we're
from
going to ask,
equilibrium position,
but we dissect it.
set of forces.
In this relationship, what happens?
Forces.
It is the
Set
employees
up
that
what we call
basically
forces.
renders what you call the sum.
Set of forces. Divergence from
In this
equilibrium.
kind of
When you go
relationship,
from equilibrium,
let's say
you go to
person
price
that we call
P2 and you go to
employee,
P1. It
the
doesn't
person
come
that
back to the
basically
equilibrium.
call
Part.
employees.
It doesn't come back to the
Employees, they
equilibrium. Part.
render.
That is what's
We
called
say they
divergence.
render what
So when you have a
the
divergence, let's say for example we
services.
have
this gentleman basically
equilibrium
render
price
what you call
P1 away
the
or
services.
P2 away from the
Then the
equilibrium.
person that we
They
call
don't
the
get back.
employer,
Divergence.
this person that basically
Divergence from
called the
equilibrium
employer,
position, set of
we
forces
basically say that
which
they
tend to
reward
push
what I call the
forces
services.
which-
They reward
which
what
we
I
say
call
which
the
tends
services.
to push
They reward the services.
which tend to
Tuko
push
pamoja. what we call the equilibrium.
They reward the services altogether.
Which tend to push the
Together,
equilibrium.
they reward what you call the services.
Which tend to
But
push the
something very
equilibrium.
interesting
In this particular relationship, there's a taxman that basically comes in. A taxman basically comes in what you call the price in this relationship. Tend to
and how does the taxman
basically comes into this relationship? That is a question.
How does the taxman basically comes in
from
the taxman basically
comes in to share in the reward?
further away from
The
what called
taxman comes to
equilibrium,
share
further away
in what
from
you call
equilibrium.
in the reward.
So when that happens,
taxman
you
basically
see,
comes
let's say
in
you
to
have
share
this equilibrium
in the
price
reward.
P2,
If you're
and you
given
have
50,000,
price P1.
the taxman
So
must
if you
get
move to
something
P2,
out
the
of
price will
50,000.
basically move further away, further away.
If
The
you're
price
earning
will not,
50,000,
the price will
taxman
not
must get
definitely
something.
move to. The price will
Must
not
get
move to
something
equilibrium
from
that price. We call it unstable
To
equilibrium.
coconut.
We call it unstable
Do you
equilibrium.
love that the
or
taxman
market
is getting
equilibrium.
something out of your money?
Together before I draw that diagram.
Do you love that the
Elewana.
taxman is getting something out of your money?
Why?
Do you want to walk on roads that are not tarmac?
Are we together?
Your car
Kama
walk on
tubonyeze
roads.
yes.
Do you want to move on streets that are not electrified?
Thank you so much.
Learn to
The only issue
respond
we have with
very
taxes
fast.
is misappropriation of
So then you
taxes.
have this.
But taxes are a very good thing. The only
we have
issue that
price.
we have with taxes is the
price,
misappropriation of taxes.
Quantity.
But basically
This
now
is
I get to
quantity.
the critical aspect that we need
And
for our running and
have
private
this.
income. So for
And
taxation, I touch on the aspect of reward. This is very important. We need to understand that for tax purposes, we need to understand the rewards
So this is
or
T.
benefits are
This
classified into
This
two.
is supply. So we need to understand this is very important. And this is for tax purposes. This is for tax purposes. We understand that rewards. So what we call benefits here. Benefits, we say are classified. Are classified. We have that into two.
We have
So for tax purposes, we basically understand that these rewards have stock benefit that are given to the P2 PE are basically classified into two. So the classification number one is what we call the cash. So we don't have the cash going back.
Are we together?
Benefit.
So we have on this side
Benefit.
because this is
what we call the demand. Call it the tax
excess
cash
demand.
benefit. Stock reward.
And then
The second
here we have
call
what
it the
called
non
excess
cash benefit. The non-cash.
So we have
benefit.
excess demand,
What we call
and then we
the
have what
the
we call
non-cash
excess
benefits to what we call the reward.
excess demand,
Reward.
and then we have
So for
excess
tax purposes, supply. We basically
So let's say
understand there are
P1,
two types of rewards.
P1,
And these rewards are basically
like I was saying, these are
as a
distributed
cash benefits to reward,
stable,
and then we have what we call a
market is a
non-cash
stable
benefits
P1
to
and
call the reward.
market
Reward.
with some
Is the
market
point at all?
is unstable.
So I want us to start with the cash
Stable
rewards.
at
Cash
P1
to
P1.
P1.
Yes, kama tuko
What
pamoja.
was I calling them? Displayable price.
Thank you
The
so much.
market
is a stable.
So I proceed to what we call the cash
and
price.
two.
Cash, the market
Rewards
at those prices.
So
That's why
rewards
we call them
called
disequilibrium prices. So the market
today,
is stable at P1, and
Elizabeth,
at the same time the market is.
if I was to tell you
P2,
that this is a
to
cash
get a price,
reward, what would it basically
so
mean?
I've said that the market is
When I say a
unstable
cash reward,
at this price, and the market is unstable at this price.
when I
So
say
you need to
cash
understand
reward,
what I'm about to say.
when I
Next.
say cash
Because
reward,
under this market, unstable market, or
You are blank.
equilibrium market,
no, but you
these
say
prices
something
do not
that
get
is the most
back to
important
equilibrium
thing.
price. They move
Look at
further away.
Away.
When I
Are we
say
together?
cash reward, so we need to understand that at price P1,
And the let's say
there is excess supply.
follows
So when
next.
you look at P1, given in form of
P1,
P1,
are we together?
these are the ones that are
Understand
given
this.
in form of
What
excess
Cash, are we together?
supply.
Employee get in form of
Supply.
cash.
In form of cash,
just supply.
just
At
abbreviate
P1,
because you have the note.
There's what
we
we call excess
You get
supply.
it in form of cash
Together at P1,
Cash to what we
excess
call
supply,
money.
and I've given that.
Which
pushes
pushes
the
the
price.
classification. This one which
Classification.
pushes, we understand pushes, what
So
we
we
call
call
price
examples.
downwards, rewards that
Which
increase
pushes
get
the price
in form
of
of cash,
downwards, or this
called the
will
mark.
push the price downwards,
Please,
which pushes the price
are
downwards,
they are
away from equilibrium,
classified as follows.
away
We just say
away
taxed.
from what
We
we
just
call
put down
from
taxed
equilibrium price.
as follows.
Equilibrium,
The taxed as
equilibrium
follows.
price,
Together.
away from what we call equilibrium price,
PE.
away from what we call equilibrium price,
PE.
So when this price is it doesn't go back. When you push it, it pushes far away. It doesn't get back to the equilibrium. There's excess supply. Price is pushed downwards, but it doesn't get back to what you call the equilibrium price.
First one is what's called the main employment
scenario. I can talk
what
about
the main
So the first at the point of your mind, understand that at P2 there's now
employment.
We call it excess.
We call it the main
to get
employment.
At P2 now we have what we
call it the main
demand.
employment income. We have what first we call it main employment.
Are we in agreement that we have? I want to dissect on that main employment. P2 we have what called excess and see how basically demands what's called the main excess demand
employment
together.
I want us to dissect
excess
on the main employment income.
Excess demand.
Composition of the main employment income.
So composition of the main employment income. We basically understand that push includes, excess demand tend to push.
We have the salaries
tend to push the price up.
We have wages
push the price.
We have salaries, wages.
The price.
We have salaries. We have wages. We have salaries. We have wages. Bonus paid
to push the price up.
We have bonus paid
away from equilibrium.
Bonus paid away. We have from what we call leave pay.
Equilibrium price.
Leave pay, we have the
away
pay.
From what called equilibrium.
We have sick leave
away from what called
sick leave.
So that we push the price away from what called equilibrium price. Equilibrium price.
Tafadhali tubonyeze yes. And commissions.
So we don't have a scenario where price gets
commissions, but they move further away. So that is the last type of
what we call main employment.
Call it the neutral.
Together.
Call it the neutral
main employment.
Equilibrium.
Overtime pay also falls under the main equilibrium.
Employment income.
Call it the neutral equilibrium. Yes. So whenever we talk about neutral equilibrium, so the point that I'm about to raise is a very important point.
When this start,
so when if I get to question, make sure you understand this because these are very key towards answering questions. So we say there are all taxable benefits. It does not involve when you see them. Mark the word. It does not all. We say involve.
Say taxable benefit
forces.
It does
definitely all taxable benefits.
When this term
it does not involve forces.
It does not involve forces.
What we call all taxable benefits, except
which
they are all taxable benefits.
Can you say except
what we call they are basically all taxable benefits except
the equilibrium.
That when there's disturbance, there's no force that we take back.
We say for
that does not evoke force to restore the equilibrium.
Except for people.
So we are not going to restore the equilibrium.
Disability.
But
so they are
moved to another position.
When you say
an income is a taxable benefit,
we say but
what does it mean?
We say
it means we subject them to
another.
It means we subject them to taxation
of rent.
So we say they are all taxable benefits
of rent,
except it doesn't invoke forces. Then these people with disability, they must have exemption certificate, but it simply do what? It creates another position of disability. When the first one another position of rent, where it doesn't get back to the equilibrium position, but creates another position of rent, where another position of rest.
Allow me to draw the shillings
for you.
We call it
so on this side we have the price
50,000 per month.
On this side we have the
first shillings 100
and 50,000 per month, and then we have
one
quantity. On salaries,
so we have the prices
is exempted from tax.
The quantity exempted. So we have the prices exempted, and then we have from tax.
Quantity.
We have the prices from salaries, then we have the quantity.
So equilibrium essentially should be in the middle here.
So this is basically for people with disability. I've said that the main employment income
established.
These are taxable income.
It's being put up there.
For people with disability and they have the exemption certificate, we say for salaries and wages, the first shillings 150,000 is exempted from tax.
Then we have
the first shillings 150 is exempted from tax.
Then we have demand. So these are new positions for equilibrium. So there's a new position at P2 equilibrium. So that is the first balance.
Main employment.
There's another new position that is created at P1 to the second one. It doesn't take back equilibrium where it is, but it creates another position of rest. So we have a position of rest at P2, and then we have a position of rest at P1.
Lilian,
tafadhali mnipatie kidole. Lilian, we are bit quiet.
Kama tuko pamoja.
Lilian, are we at home?
If we are at home, we respond yes.
So then we go to the second category.
We call it the cash allowances. Cash allowances.
Good things happen to those who
call it
complain.
cash
We will not complain.
allowances.
But we always love the
Cash
things to
allowances.
love your work.
So at the back of our mind, we need to understand
One of the best
composition
things
of
to
cash
succeed in life,
allowances.
love your work.
So we have
Despite
cash allowances,
opposition, love what you do so much that let you take everything from you.
Allowances.
When you love what you do, you will always
Allowances, we
succeed
have
in it.
what they call the hardship.
So we need to understand a neutral equilibrium.
Allowances, a neutral equilibrium. Hardship allowances.
Neutral
We have per diem
equilibrium.
etc.
We need to understand that the neutral equilibrium.
Per
I have to start
diem
checking on assignment. It's only Charity who's giving me assignment. I have to follow up on assignment. That is the semester.
Allowances.
Neutral equilibrium of cars.
Yes, transport allowance. That's okay. Transport allowance.
Or cars
those are
when we say demand.
Allowances. Are we together?
And what cost supply for the demand
Together.
supply?
Are they all taxable benefits?
Neutral equilibrium of cars.
When you say cash allowances
and supply,
are they basically all taxable allowance?
Supply
taxable benefit?
We just say in the diagram.
When you say cash allowances,
in what's called in the diagram.
When you talk about cash allowances,
when demand and supply allowances diagram,
they're not all taxable benefit. That's a statement that I have to say. Is it
coincide with the range of prices?
Is it true? That's not true.
What you call range.
That statement is wrong.
Range of
people who are doing
prices coincide with the range of prices.
That's a trap.
Coincide with the range of prices.
Cash allowances are
from P1
taxable.
Is a trap.
Is a trap
from P1.
Yes.
To P2.
Except for per diem
prices from P1.
Remember, per diem
to P2,
whereby
Q1 remains
cash allowance
where this not
it's only
whereby
taxable.
Whereby
above 10,000.
Whereby
so they are not all of them are not taxable altogether.
We say remains,
to say that all cash allowance are taxable is wrong
unaffected.
Because per diem are we together?
So the
because of
quantity does not
together. They're all taxable benefits except per diem.
What changes is equilibrium position.
All of them are not taxable. So
but quantity remains. It's only the price.
I know you people
so price we form a new equilibrium.
But every time you get to the counter of those,
and then we form a new
we also assess those into CD. If
an
examiner tells you cash allowances are all taxable together, wrong statement.
You give me yes.
Because per diem, so all of them are not taxable.
I think either in 20 April
are not
either in April or
so we can say they're taxable except for per diem.
Equilibrium.
Per diem.
So you talk about what importance of,
but not all of them don't say taxable. Except
importance of what we call concept equilibrium.
What
so we talk about importance of the concept
except for what we call the per diem. Importance.
Per diem.
What is the per diem? Importance. The question is what is the per diem concept? We call it per diem or the concept equilibrium. Importance of the concept.
Employees when they're out of office for official.
Importance of what we call this concept
equilibrium.
What is the value of this concept equilibrium?
Out of
we say useful in economic analysis.
We call it for official.
Useful. We say useful. Duty in what we call it.
So when you have employees and they're out of office,
economic
basically for official duty, we pay them per diem.
Since we say it assist in what we call it in economic. Call it economic generalization. So there are two concepts here. Generalization.
I call it up to.
So why is it important? The concept of equilibrium is very important because it assists in what we call
June
economic analysis
2020,
which assists in what we call economic generalization
up to June 2020.
So you go to predicting the path.
Helps in predicting.
The fast, we say that the fast,
what we call predicting.
The fast,
call it predicting.
Shillings,
what we call per day.
The path,
per day is exempted from tax.
Predicting the path.
And what we call speed. And the speed of what we call economic.
So look at that statement.
And the speed
so if you
of
look at 2024, the fast, if you're given less than 2,000, 2,000 and below,
and what we call the speed,
we tax
what we call economic variable.
That is up to what?
So that is second importance of the concept.
However,
equilibrium position.
July,
the second important
July
of the concept
equilibrium. The third importance,
what is the
we talk about comparison. That is 2025. When you begin to compare, what are the changes that were effected to this finance bill? Of different. So we understand that the first comparison of different shillings, equilibrium position, 10,000 helps in economic is comparison of different is exempted economic different equilibrium position together. The first shillings 10,000 position is exempted. These are based on changes. This definitely were effected in the finance economic together. However, most of the questions that you're doing economic, most of the questions that you're doing that is now called forecasting. PFT. They will fall because you'll be given questions for 2024. So when you compare those different equilibrium position, you'll be given questions. They definitely assist in what's called economic forecasting. That is basically telling you the future. That is what's called. So mostly if you start from 2024, that is the first 2,000. You become more of a prophet together. You tell of the future. Together, team. You tell about the future. Together. So then we have what you call. However, when you get to questions that will be touching on 2025, you must remember if the touching on 2025 from January what called welfare to June, from January to June, economics, the first 2,000. Welfare economics, July to December, provide guidelines from July to DEC. Is 10,000. First 10,000 is it provides. Took up how much? It provides called guidelines. So it's a point that you need to mark. Must it as provide guidelines of your guidelines for optimization. So number 2, we have exhausted. So a statement that cash or cash allowances are taxable is what called in that statement is not true. In economic, because per diem we call it restriction. Per day generalization, yes, per day optimization. Yes, per in allocation, per day, not generalization in allocation. Sawa allocation of what we call of economic resources. Sawa blessing, economic resources. Blessing. So it's assistant useful. So then we get to the next cash allowance since it provided called guidelines. School fee in allocation of what we call economic school resources. School fee. So then I want to talk about calling the school fee. School fee. What paying for employees dependents market paid. I proceed to what called employees of what they call unstable market. Why would the market get to dependents? So what employees causes, what we call the causes, paid for employees causes of what we call of unstable. By unstable market. By what's called by Christian, the employer. What causes a market to be unstable? We just talk about 5. The rest you can get from the notes. What will cause a market to be unstable? Number 1 is unfavorable weather conditions. On behalf of what we call unfavorable. So school fee paid to employees dependent, whether by employer or behalf. This is one of what we call employees. And dependents are who? Emma. As one of the factors that cause the market to be unstable. So we have issues increased taxation. When the government says tax higher, increased taxation by the dependents. You also have what children. Those are independents, which you can call it taxation. Those will be dependent. So if your boss, for example, by what you call the pay school fee, increased taxation, you are children by the government. Then I want to talk about the concept. We can have scenarios where we taxable. We can have a scenario where we tax them. Taxable. I want us to talk about this concept that we say basically calls. We can have the second scenario where this school fee is not. Talk about this concept that we call. So I want us to synthesize. Scenario where they're taxable and scenario where they're sticky prices. That's the concept that we call the sticky prices. We start with the first scenario. And that scenario prices. So whenever we talk about this concept called sticky prices, we say that whenever we talk about this concept that we call sticky, taxable, we call this concept sticky prices. Whenever we talk about this concept that we call sticky prices, whenever we talk about this concept that we basically call sticky prices, I want us to pay attention. It is taxable if the employer included the school fee in the income committed to keeping price the same for the whole year. That the firms may basically be committed to keeping the price the school fee the same for the whole year together. The firms may definitely be committed to keeping the price the same for the whole year together. Team, the firms may be committed
to keeping the price the same the whole year.
If this school fee is basically included in the
Even
income
though
statement,
if the farms are committed
by the
to keeping the
employer,
price the same,
then therefore
the
in
whole
that
year,
scenario you're going to tax the employer.
therefore we need to understand that even if
say that if the school
what we
fee
call seasonal increase
is
in demand,
included, even if there's
if
what
the
you call seasonal increase in demand,
the income statement,
there would be
shortage employee.
There would be
shortage.
Which you're now going to tax.
There will be
shortage since the
If
farm
the school fee
may not want to
is
keep on
basically
included
the prices
in the income
since
statement.
the farm may
In the
not
income statement.
want to keep
Then
on
this
changing
is
the
the
price.
second
So
scenario.
if the price is low,
Not
and there's increase in demand, the
taxable,
farm will
taxable
stick the
on
price to be the
the
same,
employee,
and therefore it create a shortage because the farm
employee,
decide deliberately to keep.
if the school fee
keep the
was not
price the same.
included,
When that happens,
if the
the
employer,
shortage will be created
if
altogether.
the
The
employer
shortage since the
Employer
farm may not want to keep on, especially when
not-
demand is volatile.
did not
Farms can annoy
call it
customer
include
frequently by pushing it up.
the
So
school
that is
fee,
what's called sticky price.
the school fee
Together.
in what called
Another
in
reason
income
for
statement
unstable market, you can call it
did not include
changes in
the
business
school
cycle.
fee
When
in
you
the
have
income statement.
recession,
So scenario two, we call it
we don't
changes.
tax
You
it,
can have it as
we
changes.
don't tax it
changes
if the
in what we call
employee
in business.
do not include the school fee in
call
the
it
income
cycle.
statement. That's basically it was tax on the
business
employer.
cycle.
It basically implies that
When you
tax
have issues to do with
on the
recession,
employer.
it basically
Recession,
implies that it was
then we
taxed
have
on
balance
the
of payment.
and
Is that understood?
payment
So what are the points to look at in an exam?
of what you call
The school fee
payment
was included in the income statement.
equilibrium.
This school fee, employer is paying for
Equilibrium.
employees' dependents on
So
behalf
when
of
you have
employee,
import
and this
and
school
export
fee
not
was
back,
included
balance.
in the income statement.
that
It
is balance
included.
of payment.
It means
When
it
you
was not
have
taxed, so
import and
therefore you
export
tax
not
the
back,
employer,
not
employees.
employees. That is
Together,
what you
handle.
call balance of payment.
You tax
equilibrium.
the employee.
Together team. That is
Anna
what called
Tukosawa.
market
Anna
disequilibrium. That is what you call
Emma Nyokabi,
balance of
Tukosawa.
payment disequilibrium.
Emma
Import and
Lilian
export are not
Otito.
balanced. You know that when import is greater than
So the second
export,
scenario, if it was not
we have what
included
we
in the
call
income
a
statement,
deficit
we
balance
don't
of payment.
tax. It basically
But
implies
when
that to start
the
from
export is more than import,
then
we
that
have
is
what we call
the third one.
surplus disequilibrium.
That is the third one.
Balance of payment. Surplus balance of payment.
So we move to the
team.
next scenario.
Another
Yes.
cash benefit. We call it medical benefit. We have
Asante Gilead.
call it the medical.
Kitawe tuko pamoja.
We call it the medical benefit.
Kitawe
We
tuko
call it the
sawa.
medical benefit.
My representative
So
Priska.
medical benefit. Two concepts that I want the
Charles,
students very
are
key
we
when it comes
together?
to what is called the
then
medical
proceed
benefit.
to what's called market failure.
So I want to bring scenarios where we definitely
Discuss
have
called the
what
what
they
they call a medical benefit. So
failure.
these are scenarios where employer
We
pay
discuss
medical
this
for
that we call the
employees.
market failure.
So
Employer
whenever
pays
we
for
talk
medical
about
for employees,
market failure,
and
before I get it
employer
down,
pays, scenario where
what is
employer
this that we call the market failure?
employer
What is this that we basically call the market
employer
failure?
pays
What is this that we
medical
call the market failure? So whenever we talk
call
about
it
market
for
failure,
employees
this occurs when there is
For
inefficient
employees.
allocation of resources.
and that
We say inefficient. It
called
occurs when there is
at their
inefficient. We say inefficient allocation of what we call
and what calls the
resources.
dependence. Pays
Inefficient
medical for
allocation of resources.
employees and what
Of
calls the
resources
dependence.
in a free
The dependence
market.
pays
In
medical
what you call in a
for
free
employees and what
market.
called their dependence. The dependence.
call it
Again,
inefficient
understand that
allocation
these scenarios again
of
also have
resources in a free
We
market.
have a scenario
i.e.
where we tax
goods
and then we have
services
scenarios
are
where
not
we don't
on Pareto,
tax together.
i.e.
So
two concepts that you
goods
need to align. Are we
and
together? Two concepts that you
services
basically need to
we
align.
say are not
Are we together? Two concepts
we
that are
say
very
on
key.
Pareto.
You can have a scheme.
Pareto
We have two types of
are not
scheme.
on Pareto.
We have what's called discriminatory. I'm discussing what you mean by
Discriminatory.
discriminatory. But at the
You can
back
have
of
a
your
scheme
scheme,
that
I want
is
you to
discriminatory.
understand
And then we have
when
a scheme
somebody
that
asks
is
you what is a market failure,
discriminatory.
market failure is inefficient
So we
allocation
have
of
discriminatory,
resources in a free
uh,
market. That
and
is a simple
non-discriminatory.
definition. I want to expand on what we call market
So
failure.
if I talk about a scheme that
So,
is
Priska,
discriminatory,
I say market
basically
failure
talking about a
you
scheme
simply
that
need
is
to
based
understand
on
that is
employee
inefficient
employee.
allocation. When you get to a question,
Of what
for
they
example,
call
the PFT
of
exam maybe
resources
2025 in a free
December,
market.
and you're being told
Inefficient
that there's a medical scheme
inefficient
senior manager
allocation
There's a medical scheme for senior manager.
Resources are not allocated senior manager.
Does it mean
So we call
discriminatory?
it inefficient
Yes,
allocation of
resources,
resources because it's only paid
We'll
to
say
say
in a free market.
a few
That
employees.
is a market fee.
Are we together? That is the market.
So if you have such a scheme
yes.
that is paid to a few
That is a market
employees,
figure.
for example,
Inefficient
the medical
allocation
scheme was
of resources in
provided
a
to
free
the
market.
senior.
So
I've
all senior
gone
managers
further and say that, you know,
Lillian, I'm
you
saying
basically
that is
understand that goods and services
discriminatory.
are not
Together, Lillian,
Pareto efficient.
that is discriminatory.
Are not Pareto efficient.
In that scenario, the
if you have
Japan
such a
scheme
scheme
that is only paid to a few employees.
Pareto with tax efficiency. In that scenario with tax, so allow me to tell you what you mean by
Pareto efficiency.
Allow me to say
taxable.
to tell you what you mean by
Tax
Pareto
efficiency.
efficiency.
So whenever we
Such
talk
an
about Pareto
income,
efficiency,
such a medical benefit will be
is
taxed,
basically a state where
taxed. So then
we say that
the second state where
scenario
resources
or
cannot be allocated
scheme.
to one individual.
This scheme we call it
without
non-discriminatory.
making at least
When
one
we say
individual
non-discriminatory,
together.
we basically say paid to all
We
employees.
say that
Paid
is a state in an
to
economy
all
where
employees.
if we allocate
Paid to what we call
resources
all
to one
employees.
individual,
That's
then
the
one
scheme that
individual
we
has
talk
to
about.
pay
Paid
what? To what we call to all.
So we call it
employees.
is a state in.
So when you say
where
a scheme that is resources
not
cannot be allocated
basically
to one
paid
individual without
to
making
all
one,
employees, do we
the other
tax?
individual
Or
was.
we don't tax.
Together.
So such a scheme now
It's a
becomes
state,
non-taxed where we don't tax. Such
State
medical
where
benefits are not taxed.
resources,
Non-resources. Such a scheme
cannot
becomes non-taxable.
say
Such a scheme
allocated, be
definitely becomes what we call non-tax.
allocated
Non-taxable. Such a scheme
one individual,
we
one
understand becomes
individual,
non-taxable. Such a scheme becomes
individual,
what we call
say
non-taxable.
without
Such a scheme we call them non-taxable.
one individual,
Together.
without one individual, without
We respond to this.
without.
So then we get to the next, we call it
One individual,
that was number
cannot be
4.
allocated
We
to
go
one
to what we
individual,
call cannot be
employer's
allocated to
contribution,
make, cannot be allocated to make,
employer's contribution. Number 5,
cannot be
allocated
allocated
employers to make employers contribution, one contribution individual, we call it on behalf, individual better off, on behalf better off of employees without at least employees without at least what we call to a registered without at least one registered better off without at least employers contribution on behalf of making one individual to a registered making pension, say
pensions
making
to provident fund,
one
registered pension,
individual.
so what we
One
call
individual was off without making one individual was
We just say to a pension scheme.
one individual
The one
was
to
off
a
without
pension,
making one
to
individual.
pension,
It's a
to
state
what we call
where
provident fund.
resources
So,
cannot be.
What do we need to
can-
understand on this?
When
employees
it's a state where resources
to
cannot
to
be
a
allocated
pension
to
scheme.
one individual
And
to
it's
make
a
him better
pension
off
scheme.
without at least
And it's a
making
registered pension scheme.
someone worse off. Do you believe? Anyway, as
Two
Christians, we
things
don't
that we need
believe
to
that.
understand.
Uh,
Two things that we
but
basically need
see
to
the world
understand.
Priska,
When you
the
talk
world
about a
believes
pension
that
scheme,
for you to succeed,
we have pension
you
schemes
have
that
to
are
squeeze
registered, for
somebody
example,
for you to succeed.
NSSF.
Is it true? Priska,
NSSF, how would you get it?
Priska,
So if
do you believe you have to
have
succeed by
number one
crushing
registered
somebody
in order to succeed?
call it registered pension?
Because if you
scheme,
look at Pareto efficiency
pension
scheme,
that we cannot allocate
and then we have
resources to
to
make
make
one individual
call it
better off without making
non-registered
one person worse
non-registered
off.
pension scheme.
And that's why they
So
call
if
Christian
employer
that
basically
Christians are
contributes on your
failures.
behalf
to
to a
because the
registered
values
pension
that
scheme,
Christians uphold
if
does
employer
not
basically
require,
contributes on your
you know,
behalf
capitalism.
to a
Remember
registered pension
what we
scheme,
talked about capitalism.
you know,
You don't care
to a
about
registered
others.
pension scheme,
You simply care about yourself.
but you're saying that
To a
to a
registered
registered
pension
pension
scheme, then that
that
is
you cannot
non-taxable.
allocate
Contributions
resources to
on
make
behalf
one
of
individual
employees to
better off
registered pension
without
scheme,
making at least
NSSF,
1% worse off.
non-taxable.
That is what called Pareto
taxable
efficiency.
not.
Then I want us to discuss what we call
So
causes
towards
of
you
market
need
failure.
If that contribution
In the
is
market
made,
failure, we say
if the contribution
is made
allocation of
to a
resources
scheme that
in
is
a free
registered,
market, then
so
that's
I
what
want to
you
talk about the causes of what we call
tax
market failure.
Two copper
What
money.
we call
If
the
that
causes
contribution
of market
is made to a
failure.
scheme
That we say is
we
not
call it the
registered,
causes
then
of
we
market
don't tax.
failure.
The second scenario,
We call it
you're
the
making
causes
contribution to unregistered pension schemes.
causes
That one we are going to tax.
of what we call
This one
of
becomes
market
taxable. This one becomes
failures.
taxable.
Two causes of what we call the market.
This one comes taxable.
Causes of what we
To
call
Bonyeze,
market.
yes. Then we
fee.
proceed to the sixth one.
Causes of what we call market fee. I think we can discuss before we go for a break.
Call
So say
it
imperfections. We have imperfection in the market.
We call it
Are we together?
insurance.
Imperfection in market situations.
Next, we call it
The insurance.
So just
call it
benefit,
market
we call it
imperfections, you know.
the
Insurance
insurance
imperfections.
We call it the insurance.
Market imperfection.
Together.
One of the market
I want to start by
imperfections,
making a
and then we're
statement.
going to discuss
A very
last
interesting statement.
in microeconomics.
A very
We call it
interesting
monopoly.
statement.
One of the markets
along the way,
we call it monopoly.
We call
Who
it the
can
journey
tell me
of
what monopoly is? We're saying one of the market imperfection
we call it the
is
journey of
monopoly. So the monopoly,
we face a lot
we
of
simply
challenges.
have one seller.
And
selling a
sometimes
unique
the
product
challenges are too waiting.
and is selling them a
It's
unique
not to
product
encourage somebody.
without substitute.
Because
what happens
remember,
to
it's
this
God
person?
who
This
this
person
person
can basically
learning is not
manipulate
about knowledge.
all the buyers.
Sometimes
Because he has
it's about
control.
little advice that we get along
Remember,
the
the
way
government does
and
not
encourage
tolerate
students.
monopoly.
Sometimes
Except
you feel like
maybe
giving
for
up.
beneficial monopoly,
Sometimes
like the state owns monopoly.
and you don't know
One
what
of
to
the
do.
reasons why we have inefficient allocation
My answer is
of
hanging there.
market failures is market imperfection.
Sometimes you feel like the
Example
road is closed.
monopoly.
Keep on doing the
Together.
right thing.
So
And
then
the
we
right
have the
thing
next
is to show
what
up
we call
with
lack
us.
of public goods.
And keep on doing the assignment.
Lack,
We will
next
overcome.
will be lack of public goods.
We will overcome.
Lack of what we call public
We will overcome.
goods. We call it
Don't even
lack
try
of
to
public
give up.
goods.
Hold on there.
The next will be
Strive.
lack of public
Even
goods.
if it's 40 minutes, you're coming.
Then you can also
just
have,
come.
where do we have
Get
inefficient
that knowledge
allocation?
and
Outbreak of
get back
pandemics.
to the video.
Like remember COVID-19.
So back to the insurance
and have
benefit.
issues to do with outbreak.
The first scenario, if you're
of
paying
what
for
we call
insurance benefit
pandemics.
yourself, is it a benefit?
Outbreaks of what we call the pandemics. I.e., we have what we call COVID.
Awika.
Call it COVID-19.
My good friend.
Remember,
If you're paying for
COVID-19.
yourself insurance,
outbreak of
benefit.
COVID-19 that led to
if you're
market
paying
failure.
for yourself
You
insurance,
also have issues to do with unfair distribution
if you're
of
paying
resources
for
in a
a
free
small
market.
break,
When you
okay,
have unfair
there's
distribution,
need for a break.
we have what we call
A
unfair
break, we can have our break.
distribution,
So,
distribution of resources in what you call in a free
so
market.
then
So when you say unfair,
benefits,
some people are given more
two
resources.
things
some
that
people
I
are
want
given
to lay bare.
so that lead to market
Number
failure.
one, if you're paying
Unfair
insurance for
distribution
yourself,
of resources in a market where some individuals
I'm doing that. Experience poverty.
So for the
and
pension
homelessness.
scheme, why do they experience
There were
poverty?
two
Homelessness?
contribution
Resources
employers
are not gotten to
contribution
those
are
other individuals.
to
We
what
can
they call
also
the
talk
pension
about
scheme.
so
I
a
basically
negative
talked about
externality.
pension scheme. Like two types of
usually
pension scheme.
we can have
We have a
negative,
pension that is scheme
what
that
is
is
the
registered,
negative
for example, in a second
externalities.
pension scheme. And we have schemes that are not registered. So I basically say that if an employer is basically
Negative
contributing on
externalities
behalf
such
of
as
you
pollution.
to a
What you call the
pension
negative
scheme, then
externalities
that is a
such
non-taxable
as pollution.
If
They
employer
say,
is contributing on behalf of
agriculture
employee
is often
to a
subject to
pension
market
scheme,
scheme. If you look at
then that is a
agriculture,
non-taxable.
as the
income.
last
We
one,
don't tax.
agriculture,
We don't tax.
is
The second
is
scenario we're
often,
saying,
if
if
subject,
employer is
we say
basically
subject,
contributing,
we say to market
we
failure,
call it on
subject
behalf
to
of
market
employee to a non-registered
failure.
pension scheme.
So we need to understand
Then
that agriculture
in that case, we're going
is
to
essentially
tax that
often
contribution.
subject to what they call
To get
market
other
failure.
In that
market
case, we're going
failure.
to tax
Why?
that contribution.
Because there's what you
We
call
are going
volatility
to
in
tax
price. The price
contribution.
keeps on changing.
To
This
Bonyeze,
is what we
yes,
call
come to
volatility.
we are
Volatility
going to
in
tax
price.
the contribution.
Why that?
So then you
Due
proceed
to
to
what
what
we
we
call
call insurance
volatility in
benefit.
fact, in
I
price.
first of all say
The
that
price
if
of
you're
a petrol
basically
product
contributing insurance
keeps
for
on
yourself,
fluctuating as a
then
result
that
of
is
weather
not a
and
benefit.
externality.
If
The
you're
price
basically
of a petrol
contributing
product
insurance for
keeps
yourself,
on fluctuating,
then that is
due
not
to
a benefit.
weather.
Remember, we're
and
talking
what
about
called
employment
externality.
effects.
So we have those six
So you get
together
portions
in the notes.
that employee was
Together.
contributing to what?
Tafadhali tuko
Was
Bonyeze, yes.
contributing to insurance.
Kama tuko
It doesn't come from employer. In those
Tafadhali
scenarios, then that
Bonyeze,
is not a
yes.
benefit. Are we together? In that
So as I
scenario,
go
that
for
is
break,
not a benefit.
I want to
Benefit.
come and discuss demand and supply interrelation.
But if employer is basically
Demand,
paying for you insurance, then that
demand,
is a taxable benefit.
and what we call supply.
So then this is
We call
when
it
employer,
interrelationship.
this is when
Relationship.
this is when
Relationship.
we say the employer,
Demand, supply, interrelationship.
employer
So we can have a
say
break.
pays
Demand, supply,
for what it calls
interrelationship.
employee. Sawa. Let's have our break then. Employees. Let's have our breaks for what we call employees. Sawa, Preska. My pen pays for employees.
Pays for what we call employees. Pays for employee. Pays for what we call employees. Pays for the employee. Life cover. Life cover. If you would call education. Yes. If you have an employee basically paying for the life cover or an education cover, with the yes, or an education cover. So supply and it is a tax supply and demand relationship. I want us to talk about the taxable benefit relationship. First, we call it taxable and demand interrelation. And that is a taxable. I want us to talk about the first, then it is relationship. What they call it is. I want us to talk about the first relationship. It is. So number one, effect of an increase in demand, taxable effect. Number one is effect. We call it that's the taxable benefit. Or what they call it for you life or an increase cover. Then that is a taxable. What we call in demand. Subject that to taxation. Subject that to taxation. Supply taxation. Meaning. Then you have scenario 7. Meaning constant. Scenario 7. If employer's contribution over half of demand, supply remaining contribution. Supply remaining call it employers. So if employer's contributions in demand, contribution supply basically on behalf constant. On behalf of employee, supply remaining on behalf of what they call employees, we call it to a members club. To a members, so we have demand members club. To a members. So club. when demand increases, employers contribution on behalf of employees, right? It results to members club. And we call it to. So when you have demand increasing, because it's moving, it results into on behalf of employee to a members club. A shift to the right. Two things that you need to remember when you talk about upward movement of demand. So we basically say when you talk about the members club. So if when you talk about the members club, we have QE members club, and then we have PE. It should relate to the work of demand. Look at if it relates to the work of the employee, we do not tax. This will be Q2. This is not taxable. If the members club equilibrium price. What happens to equilibrium price? It is not when we increase demand, supply remaining constant. What happens to the equilibrium price? Say the members club. What happens to what they call the members club? What happens to the equilibrium price? What happens to the equilibrium price? Relates. What happens to the equilibrium price? To what they call to the work. It moves upward. Are you seeing? Priska. Are you seeing what happens to the equilibrium price? It is not taxable. So the first one, demand of shift related to the work. When you increase demand, demand. So if the members club relates to the work of employee, we say shift. For example, we talk about contribution. We say to the right. We have what's called contribution. Demand of shift. We call it contribution. Demand contribution of accountants to what is called to the right. We have demand of shift. We call it to the right. Contributions of what we call demand of shift to the right. Of accountants, i.e. to upward, ISPAC upward. So contribution leading for accountants to ISPAC. Leading to contribution for accountants leading to price. So when you're contributing, employer contributing to accountants for ISPAC, you don't tax increase in because price. That relates to the work of employee. We call it. However, if it does not relate to the work of employee, you are going to tax. You are going to what we call increase in price. If it does not relate to the work of employee, then you are going to tax. So that's what happens when you increase demand and supply remains constant. When you increase so much, Emma. Then we have the next called the cost of passage. Demand and supply remaining passage. We call it the cost. So we have the second of what they call passage. So we have the second effect. The next call it cost of passage. Effect of what we call. We need to understand what you basically understand by the cost of passage. What we call demand mean by the cost of passage supply. So when you talk about cost of passage, supply remaining, we basically understand the cost remaining moving constant. Supply from one place remaining constant. What we call effect of one demand and say supply remaining constant. The cost of moving from one place to another. Remaining constant. That is what you call the cost of passage. The cost of moving from one place remaining to another. If what I call the cost of increasing, moving, we say of increasing. Effect of increasing, we call it the cost of moving from one place to another. Decreasing cost demand, of moving from one place and supply remaining constant. Do you understand the first? Basically saying that incurred by employees, have you understood from one place to another? Understood the first one? And finally, Charlie, so have you understood the first one? It is not taxable. The first part is not taxable. Thank you so much. So the second one, we understand that demand decreases. Where in the following, demand decreases in the following. So if you look at that, we're saying now supply is remaining constant in the following circumstances. So we have the demand on this end. A number of circumstances where we do not have demand, where we do not. So demand, we're saying, so this is price. We have basically three scenarios where we this is price together. This is quantity. That is quantity. That is price. That is quantity. So scenarios where we do not tax. At this point, we have. So we basically have three scenarios. Other scenarios we tax. So say employees and so when demand is decreasing, there's a shift to the left. Employees can see what is happening. Demand is decreasing. So look at the non. So we have Q1. So this one, demand decreasing. So this is basically so look at the demand curve. Now where we have the demand curve. This is G1. So there's a shift to the left. Look at the non-citizen. You don't shift to the left because of moving. What happens to the equilibrium price? Is an expatriate or a non-citizen. What happens to the number two? Employees is in what happens to the equilibrium price? Employees. What happens to the equilibrium price? What is that happening to the equilibrium price? Is in Kenya. So the market curve shift to the left, but the equilibrium price reduces to P1. Or the equilibrium price reduces to P1. So we can see demand curve shift to the left. Say observe the demand curve. The demand curve. What we call the curve shift. We say to the left. So employees is in Kenya. We to the left. The demand curve. Observing. We understand shift to the left. Observing shift to the left. So employees basically downward for the sole purpose of serving the downward. Abdi Nasir, are you okay? You have been lost in this class. I dropped him and shifted out. I hope everything is okay. Downwards, leading to decreasing price. Is okay. So then lastly, scenario, the third scenario, leading basically say the whole amount. Say leading to what we call the decrease amount to the decrease. We call it amount is spent in price. The whole amount is spent from on the passage. PE, the whole amount is spent on PA, leading to decreasing price. So the whole amount from PE to P1 is basically leading to what we call decrease in price. The whole amount is spent on passage. From PE, the whole amount is definitely spent on PE to P1 on passage. So this scenario is you don't tax. So if you're looking for cost of moving again, and this passage, in order not to tax it, one of the most important things follow this criteria. Don't look at what basically follow those criteria. Don't look at what others are doing. Please love your work. Love what you do. Yes, I am assisting you. I am here for you. So whether you say it 2 times, I will always repeat it. God will expand you and God will grow. Without you people, I'm not here. Are we together? You people are the boss, not me. You are the boss. So Emma, I'm repeating. God will expand you. The concept, this one, and God will always grow you. You must love what you do. So we have the third scenario on the passage. Is this understood? Is this understood? No. Is that the one seen is wrong? Me, I'm the second understood in the kingdom. Is the second the Bible one says, "He that is small in the kingdom is the one that is great." So I desire that to be small. Gilead, only Gilead says, "I desire not to be senior. I desire to be a servant, that I can serve you all the days of my life and serve you much better." Yes. Allah, don't cry. Why? I'm of service to people. That's who I am. I want to serve people to the end of it. Yes. Well, that is nice. I want to serve we get to the scenario. I don't want position. I just want to serve. In fact, if I'm asked what I want to do in this world, I just want to serve. I don't want any position. I just want to serve. If I'm able to serve
people to the best of
God's
God's ability.
Increasing supply.
Yes, if I'm able to serve
Demand
people to the
remaining
best of my ability, I'll be grateful. I will leave this heart so happy, so fulfilled that I've served a duty that God gave me. That is all we have.
An effect of increasing
so
supply.
we come back to this.
And you say demand.
I still would not call this cost of passage. We say that the cost of passage is basically the cost of
supply
moving
was
from one
remaining
place to
constant.
another.
But now demand
Are
is
we
remaining.
With
Cost of moving,
from
demand
one
remains
place to
constant.
another.
In the cost
What
of
is that
employment.
effect? That is effect of
Then I'm
government
saying that
subsidies.
I basically talked about
E.g.,
scenario that
you say that this cost of
government
passage
subsidies
is not taxable. We do not subject to tax under the following three.
When there's government
three
subsidies
on production of
under the following
three circumstances.
Number one,
on production
is that employee is an
on
non-citizen.
production.
And I say that employee is an expert.
Of what you call
is an
expatriate.
expatriate. Employee is an expert.
On production
Is an expatriate.
of what you call
Together.
commodities.
Employee is an expert. Effect of increasing supply.
Then the second
And
scenario
demand remaining
that
constant.
we will not, for example, when government
cost
gives
of
passage, we
when
say employee is
gives
in
subsidies.
Kenya.
So if
for the
government
sole
gives
purpose
subsidies,
of
provision,
serving
there are
the employer.
subsidies. We call it employee is in
we understand
Kenya,
one thing.
sole purpose of
we
serving
understand
one thing
the
when government
employer.
gives subsidies.
And lastly,
is that
supply
will
amount
increase together.
that we were talking
But
about
that does not affect the
is
demand.
basically spent on passage.
So
in
what will
moving.
happen? Then we don't.
So allow me to do the diagram
so that you see what.
Emma tuko sawa.
So this is a supply curve.
Emma tuko sawa.
This demand curve remains constant. This demand
Thank
curve.
you so much. Thank you so much.
So then, if you look at the
question,
remains constant.
Like I can give you these questions on my fingertips.
This demand curve remains constant.
August.
So if supply is
question on
increasing,
August 2024,
see the supply or deck
2020.
So we have
against two very precise deck 2024.
S2.
If you look at this question on deck 2024,
so what is
basically has this question?
We can see this was QE, which the quantity supplied is increasing.
This question on passage, I will talk about this was PE. Deck or
what happens to the equilibrium price?
Touches on passage.
If
another scenario, any other scenario,
increase supply,
basically fits itself. We basically understand that
increase supply
will tax
what will happen to the equilibrium price.
We will now definitely tax.
So
what
supply
the
shift to the right.
We will now tax it called the passage. Together,
supply
we will now tax the passage.
Say shift
together. So I finished on cash.
What I call
benefit.
To the right.
So then I proceed to the next scenario.
Supply
we call
curve
it
shift to the right.
Non-cash.
Supply curve shift to the right.
Benefit. We call it
shift to the right.
Cash
downwards.
Benefit. What I call the non-cash.
We call it downwards. We call it the non-cash benefit. The non-cash benefit. So when you say the non-cash benefit, what do you basically mean by the non-cash benefit?
Decrease in price.
What do we basically mean by the non-cash
decrease in price?
Non-cash
leading to what we call the decrease in price. Leading to the decrease in price. Leading to the decrease in price. We call it leading to the decrease. So shifting to the right, leading
yes,
to
they're not getting them in cash form.
Price.
So we say benefit.
PE
benefits
to P2. Leading to the decrease in price.
Employees
from PE to P2. Leading to the decrease in price from PE.
Benefit that employees.
Leading to the decrease in price
from employer.
PE to P2.
Get from what you call
from what you call from
leading to
the decrease in price from PE to P2. Non-cash form.
Benefits that employees get
from
employer.
So I have about
non-cash
diagrams.
Get from employer
in a non-cash on price control
in a non-cash form.
And we shall be able to finish on that in the next class. Cash form. We should be on the theory of non-cash form. That will be on a
together in a non-cash form.
The theory of consumer
in a non-cash form.
That is in the next.
So then the same
the theory classified of consumer behavior. Please read those handouts that I gave. I want to say that God bless you.
Can you say God bless our class?
Our class is ended. God bless you. And God bless our class. Our class is ended.
Classified.
So God bless you and God bless our class.
Basically
our class is ended. Unless somebody has something that is funny,
classified,
that cannot be postponed. Unless somebody has something that cannot be
classified as follows.
Thank you, Gillian. They are classified as follows. So number one, I want us to start with what we call benefit in kind. I want us to start with what we call benefit in kind. Benefit in kind. Benefit in kind. So what is benefit in kind? When you say benefit in kind, what is this that we call benefit in kind? Benefit in kind. Benefit in kind. Benefit in kind. What is benefit in kind? What is benefit in kind? Just a minute as I respond to something. So benefit in kind. Benefit in kind. Benefit in kind. That, for example, they are not given in a non-cash form. For example, we can talk about free transport in form of free transport, free goods or free transport altogether. In form of goods or free transport, you can have them in form of what we call goods, or what we can have free transport. These are benefit in kind. Benefit in kind. Together, those are benefit. In relation to taxation, in relation to taxation, how to go about it? In relation to taxation, how do we basically? In relation to taxation. So again, we have to around December. This is 2024 to around DEC 2024. What is the rate taxable? What is the threshold? What was the threshold? Are we together? So we say that before 2025 to around December there, it was, are we together? We say that if the value is taxable above, we say that the value is above 3,000 per month or 36,000 per annum. So that is up to around DEC 2024. Tuko pamoja. Up to together. That is up to DEC 2024. Nipatie yes tafadhali. Up to Nasir. However, from 2025, around December 2024, 2025, it changed from this basically 5,000 per month or 60,000 per annum. Tuko sawa. Together. Tuko sawa. Perfect. So now, this is a little bit different from body M. This one is a little bit different. So if you're touching on questions that pertain to 2024, if it's above 36, we say 36 to 40,000, you tax the whole amount. If it's above, look up. If you just find around 2024, it's above 36, you're told 80,000 for the whole year. You're going to tax. You don't less the threshold. Are we together? Once it's above, you put the whole amount to taxation, not as per year. So unless you just check if it's above those thresholds, you just tax the whole amount. You don't less like the per year. Tumeelewana?
You don't less like the per year. 2 copper mod. Together. So then we had also the meals. If you look at meals from around 2017, it was 4,000 per month and what you call 48,000 per annum. That was for the meals. This was for the meals. So when you look at the meals was essentially 4,000 per month, 48,000 per annum. But with the changes that around December, January, the were effective meals should also be, when you look at these meals, 5,000 per month, or you call 60,000 per annum. So this is the present rate altogether. Do you know in tax, how those questions can be asked? Based on changes to meals, what is the current rate? 2 marks. Remember when you changed, when in December 2024, if you look at the paper for December 2024, there were changes that were made to advanced tax. There were changes, particularly if you look at that question. I think I gave it did I give it in the revision for our first revision? So you can be asked based on changes that were effected. So this is how meals, and this is how benefit. Those are just basically benefit in kind, how it goes. Is that understood? Tumela one. Perfect. So then I get to the second scenario. We call it telephone bill, telephone benefit. Telephone, we call it benefit. So for the telephone benefit, we give it as 30% of the benefit. We give it as 30% of what we call the benefit. We give it as 30%. We call it 30% of the benefit. 30% of the benefit. What is telephone benefit? The question is, what is telephone benefit? Where employer pays for telephone bill, employer pays for telephone bill, employer, we say pays for what it called for the telephone bill, or gives, or say gives free airtime, we say to the employee, or gives what's called free airtime to the employee. So pays telephone bill or gives what's called free airtime to what we call to the employee. Pays for the telephone bill or gives free airtime to the employee. So how do we tax it? How do we tax that? We say the taxable amount is 30% of the bill. Taxable amount is 30% of what we call of the benefit. 30% of what we call the benefit. We look at 30% of the benefit. Together, we respond with this. That is how we tax 30% of what we call the benefit. 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 So we call it 30% of the benefit. Somebody is asking something. Allow me to check. I can be moving without checking what students need. Somebody was asking. Which about the pidget. Somebody is airtime is just for work. Those are employment benefit. You know, the benefit of the employee, benefit that is given. If it's that's an organization. If it's it should be for private. Most cases because that's an employment benefit. Are we together? Benefit A. It should be basically benefits of the employee. Benefit of employee. The benefit of employee. So what's what? Together. Perfect. Then I proceed to what we call furniture benefit. I proceed to what we call the furniture benefit. We call it furniture call it the furniture benefit. Furniture benefit. So again, also furniture benefit, it is 1% times the number of months, look at the word, times the number of months, times what they call the cost of what they call of the furniture, times the cost of what they call the furniture. So 1% times what they call times the month times what we call the cost of furniture. So, for example, you're provided, most of the time, when you talk about furniture benefit, it's always tied to housing benefit. In most cases, you'll always find there's a housing benefit together. Most of the time, when you particularly touch on questions that have the furniture benefit, you will not find what's called the housing benefits in those particular questions. You will always find housing benefit. You'll always find housing benefits always attached to those questions together. But you're saying you are basically housed, and you've also been provided furniture together. You are housed altogether. So this employer gives, just say employer gives, we say gives a person that we call employee. Employer gives what we call an employee. Employer gives the employee. Employer gives the employee. Employee furniture. Furniture gives employees what we call furniture. You are out and you're provided with also the furniture. So that is where we have what we call a furniture benefit together. Furniture is used in a house. We know that this furniture, we basically say is used, we say it in what we call in a house provided to the employee. Provided to the employee. Provided to the employee. To the house provided to the employees. Are we together? To the house provided to the employee. Are we together? To the house provided to the employees. Are we together? So the taxable amount. When I look at the taxable amount, how should I go about it? Look at it. We say that should be 1%. That should be 1%. Be very keen. Most of the time, people don't look at this times the number of months. If it's not housed for 12 months, then you cannot use 12 altogether. If it's housed for 4 months altogether, then that should be 4 months times what we call times the cost of furniture. Of what we call of the furniture. Times the cost of furniture. Times the cost of furniture. Times what we call the cost of furniture. I wanted to extend, but I remembered it's a weekend. I remember it's a weekend. Some people may be on my neck. I'm monitoring the syllabus clearly. Tim, Ogembo is not our representative. Emma, I wanted to extend, but while I wanted to extend, I noticed it's on a weekend. So I'm retracting a bit, not to interfere with your weekend. So I want to leave you, have the rest of the weekend, but know that I'm monitoring the syllabus. We are not badly off. I'm monitoring everything. I'm basically monitoring everything. Yes, I talked about it. I'm still looking at something. You people are ready. You see, you are the bosses. If you're ready and you tell Molimo that we are ready, yes. I'm working with you. Yes, on the weekend. I will work with you. Just let this month fall. As you call for it, you remember I told you you are the bosses. So when you call for me to come in the morning, I will. Very early. Yes. That will be purely, yes, purely for public finance. If you want me in the morning, it will be purely for public finance. Thank you, Awiko. Nyinyi ndo mnaitisha hii class hivi. Sante. Who am I to say no? Kama ni nyinyi mnaitisha hii class hivyo, I'm here to serve. Yes, I'm here to serve. So there's nothing I can do but here to serve, to serve. God bless you, and God bless our class. God bless you, and God bless our class. Asante, Emma. Have a great weekend. Good night.